Hello and welcome to Radical Markets. My name is Galen. This is episode 2. Today we're going to be talking about interest rates. So most everybody is familiar with interest rates at some level. You've probably had interest rates applied to your credit card debts, or maybe you've bought a car with a loan or even had a mortgage. Those interest rates are determined by two types of factors. Personal factors are one type, not really what I want to discuss today. I want to talk about the average interest rate throughout an economy, and that's determined by forces much bigger than yourself. You may have heard through a relative or in an advertisement that right now is a good time to get a mortgage, buy a house. And that's because the average interest rate right now throughout the United States is very low for historical norms. You should have some sense of this from your savings account. So just like there's interest on debt, there's interest on savings, and they're tightly related. So when interest rates are low on mortgages, you're also not going to be getting high interest on your savings. So right now, if you have a savings account, you probably know you're not really making any money on that. You might be getting 0.5% a year, 1% a year, or somewhere in that range. And similarly, you might know if you were someone close to you as a mortgage, that interest rates are low. It's like 3%. That can add up when you have a really expensive house, but it's nothing compared to past interest rates, which in the 70s were around like 7%, 9%, and I believe got as high as 10, 15% in the 80s. Now that we understand that the interest rate in your bank account, on your savings account, is related to the interest on your loans via credit cards or mortgages, I want to start talking about interest rates in terms of price, supply, and demand, so you can really understand it at a foundational level. Unfortunately, I'm using Windows Movie Maker, and I have not been able to figure out how to overlay the slides on top of the video. So I'm going to put the slide in here with no audio, pause it and look over it. I'm going to put it in again at the end of the section on these supply and demand relationships. So an interest rate is often known as the price of money. When we're looking at it in terms of supply and demand, we want to think about the good as being savings. So the price of money, or the interest rate, is determined by the supply of savings and the demand for savings, which is otherwise known as the demand for loans. Supply and demand affect the interest rate as follows. An increase in the supply of savings causes interest rates to go down. In this case, there is an abundance of money being saved, and so there's a large pool of money available for banks to loan out. Because there's so much, it's not very risky for them to lend a little bit of it, basically. It gets more complicated than that, but that's a solid basic introduction to the supply side of determining interest rates. Now, on the other hand, an increase in demand for loans causes interest rates to go up. There's a higher demand, and it forces the price higher. Just like if there was a higher demand for oil, it would force the price of oil higher. So just as supply and demand determine price, changes in price will affect supply and demand. So when you have a price, like the interest rate, which is the cost of borrowing, or the price of borrowing, and you change that price, you'll have changes in the amount of supply of money available to borrow and the amount of demand to borrow money. So let's say you start with 3% interest rate, okay? This is your baseline level and then you move it up to 5%. You're increasing the cost of borrowing. When any good becomes more expensive, you expect the demand for that good to go down. If oil goes from $50 a barrel to $100 a barrel, people are going to drive cars less. Similarly, with the interest rate, if the average interest rate in an economy goes from 3% to 5%, you're going to have less borrowing because borrowing is more expensive. You have to pay back a greater rate of interest. It's riskier for a borrower to take on. On the other hand, if you move interest rates lower, so you're starting from an average of 3%, and you push that average down to 2 or 1%, then you're making borrowing cheaper, and that will cause people to look to borrowing more sometimes because it's less risky. If you have an individual who wants to buy a house and interest rates are 3%, he's going to be able to afford less house at 3% than at 1%. So he might be able to spend $200,000 on a house at 3% and still be able to afford those interest payments. But at 1%, the interest payments are smaller. So instead of spending $200,000 on a house, he might be willing to spend $230,000, because over time, with the smaller interest rate, the eventual amount of money that he's going to pay could be the same or smaller with the lower interest rate, even though the initial cost of buying the house was $230,000 at the lower interest rate, and the initial cost of borrowing the house was $200,000 at the higher 3% interest rate. So just to sum that up one more time, lower interest rates increase the demand for borrowing. At the same time, they lower the incentive to save. If you don't have any interest coming in on your savings account, you're not going to feel as inclined to keep putting money into it. If you have a savings account and you're making 5% interest a year on your $1,000, you're gonna want to leave it in there longer than if you're making almost nothing in interest, which is currently the environment we live in. Hopefully now you have a sense of some of the basic ideas of supply and demand of savings and how they affect the interest rate throughout the economy. If you don't, please leave a comment. I'd be happy to answer any questions about any holes I might have left in this lecture of sorts. In the next video, I'm really going to be diving into the current debate as to whether or not the Federal Reserve should be controlling interest rates. So thank you for watching. If you enjoyed the video, please like and subscribe. If you have any criticisms, feel free to tear me a new one, and I will see you next time. This is Radical Markets.